Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, May 30th, 5:57 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in a weakening uptrend, deterioration continuing today, especially for the first time in a few days, growth leaders taking it on the chin. Check the trend gauge over here. We've still got the four green arrows, but there's a lot of, let's say, fine print or asterisks going on to accompany those four arrows. We've got the yellow sub arrow on leaders as today, a couple of them breaking the 21-day moving average and really some underperformance for the first time, and a lack of support where we would have expected to see some support on some of these. That's the reason for the yellow arrow coming out. Short term, the 21-day moving average, multiple closes below there for the Dow, the mid caps and small caps, and the first close below there at the end of the day for the S&P 500. NASDAQ 100 still above. Second close below the 21 will get this on the S&P, will get us off of this green arrow and onto yellow. And then we'll see if the last holdout NASDAQ 100 is strong enough to hold up the market, or if we get some bounces out of these other indexes, similar to what we got today on mid cap and small cap. Medium term actual improvement today, while the Dow was down again, mid caps and small caps regained the 50-day move, either regained or are closing basically right on the 50-day moving average, as we saw a bounce there today. Still have the yellow sub arrow, however. Long term, and it's important to remember, the market never gets into serious trouble unless the major indexes break below the 200-day moving average. This is where all bear markets throughout history have occurred. As long as we're above that level, we give the market the benefit of the doubt, at least from an index investing standpoint. If leaders start to get taken out of our portfolio as our stops get hit, similar to what happened this most recent pullback, the only thing we were left holding was our S&P 500 index long, and then we wait for signals. The S&P ended up bouncing at the 20-week or the 100-day moving average, and then we set up nicely again and got a nice rally with some participation by leading stocks. So what we do is very much data dependent here at Revere. We try to take as much emotion out of it as we can. So what happened today? There was rotation under the surface. Tech hit really hard, but the value sectors were up. 9 of the 11 S&P 500 sectors were green, but tech hit extremely hard. That carries over to the growth leaders, and it took the S&P 500 below the 21-day moving average, just barely, but we'll take a look at the charts in a minute. Here are the final numbers. Our 21 over 21 list. What I do is give two numbers. I've decided to take out the high and the low and present that as the first number. The second number is if we included all of them. So very clearly not outperforming today. 8 up, but 13 down. So we'll call the range minus 1.5 to minus 2.2%. The big eight, Microsoft hit, Google hits, Amazon hit, Meta hit, and NVIDIA hit, and net down on average 1.42%. The RG8, this is our in-house developed 8 growth ETF composite, down 0.13% as small and mid caps bounced, certainly helping out mid cap growth and small cap growth there. The S&P 500 opened down 0.25%. Really couldn't get much going. Tried to rally late morning, early afternoon before rolling over and breaking a couple of key levels, down 0.6%. However, equal weighted S&P, which had been miserably underperforming the market cap weighted. See, things are always changing under the surface in here. That was up 0.5% today. So it was the big names that carried the S&P to outperformance. It was those big names that carried it to underperformance today. That's why we cover all of these things that we cover here: sectors, leaders, market cap, themes, commodities, it's interest rates, it's at the dollar. It's important to monitor all these things because they're interconnected one way or another. And as soon as the boat starts to get too full on one side, so it doesn't tip over, people have to start moving back to the other side to even the boat out. And you see that constantly, and a lot of that takes place inside the S&P 500, which is why we use this as a foundation for our portfolio. NASDAQ 100 down 1.1%, equal weight down 0.4. Dow, victimized today by CRM, hit hard on an earnings report, and that's a big tech presence in the Dow. Dow down 0.9%. Mid caps and small caps with strong bounces, 1% each. Global diversified 60/40 stock and bond just barely negative. Yields pulled back today. In-house, our flagship GROTECTION portfolio, nice outperformance over the past week, but given some of that back today, down 1.12%. And let's get into it, starting with the S&P 500, and you can see the gap down. The 21-day moving average is basically flat, and we closed just 0.1% below that, but we've been showing a 15-minute chart. We're going to expand it out to a 30-minute chart. So we have been talking for a while about how this 52.80, 53.25, after the CPI gap up on the 15th. We went into a 9 to 10 day consolidation, false breakout, false breakdown, back into the range, broke below the first part of the range yesterday, now breaking below the second part and officially making this a failed breakout above this 52.50 level. So we consolidated 3 days at 52.50, gapped up on CPI, based, and that base broke. And when things are working well, we will see that the wind is at our back and we'll add exposure. We've been basically flat with our exposure for a while because of the inability to get out of this range, and now two lower lows the past couple of days relative to that range, putting us back below this 52.50 level. Next level down is 5,200. You can see that 4-day consolidation there. As we hit resistance at 5,200, pulled back, broke above it, tested it, and then sideways before that breakout on the 15th. So we're back into this range of 5,200 to 5,250 now. And included in there, there's a prior high range. You go to the 60-minute chart here. No, you can't see it. You got to go to the daily to see this level here back in mid-March, which is, we were holding above that, but we broke back into that level again today, and the 21-day moving average is in that area as well. So failed breakout as of now. That's why we have weakening uptrend leaders still holding up, but some weakness developing today, and a little bit more after hours, although actually a mixed bag after hours. We've got Dell down. They've got a $30 billion backlog, but I guess it just ran too far too fast, and the market's pulling back after hours. On the plus side, a Zscaler, which had been an underperforming cybersecurity stock, is up significantly after raising guidance. So we'll see how that impacts CrowdStrike, which took it on the chin today, and we got stopped out of part of that. But when we get to the tail of the tape, we'll discuss that. So back to the S&P 500. So what the bulls want to see is an immediate reclaim of this 21-day moving average. The bears want to see at a minimum a pull down to this 50-day moving average, and or that 5,200 level. The 50-day moving average, the red line, will approach that level next week. So there's your S&P 500 to the NASDAQ 100. You can see a break below the ultra short-term 8-day moving average, that 8-day exponential moving average. That's the purple line, basically closing right on the pivot of this flat base. It's frequent for individual names to test a pivot. You don't like seeing it as much when an index does it, but we are still above the 21-day exponential moving average on the NASDAQ 100. The weakest of the indexes, the Dow, 3 days down, kind of waterfall action from 40,000 to 38,000. The Dow's bound to catch a break at some point. There is a big support level here, but if these expensive stocks in there keep disappointing on earnings, that's really what this pullback is all about. So bouncing at the 38,000 level, big level of support right around here on the Dow. On to the S&P 400 mid cap. After two down days, a bounce, two more down days, we've got another bounce right into or right below the 50-day moving average here. Small cap Russell 2000 reclaimed the 50-day, ran into the declining 21-day. That's the next level to get back above for small cap bulls. Let's show SPY G, which is the S&P 500 growth today, which had been outperforming, still above the 21-day moving average, breaking the 8. So this is the growth half of the S&P 500. Compare that to the value half, which had been underperforming, but showed the outperformance today. You can see this is under the 21 and the 50-day moving average. So like I said, when one side of the boat gets too full, in this case, the growth half of the S&P 500 relative to the value half, these things tend to snap back. And that's what we saw first day out of the box today anyway on this pullback is rotation into value names. You can see the relative strength line lagging badly. Look where it is relative to where the price is. Higher highs across the board, but a lower low on the value half relative strength line. And as I said, those things just don't persist forever. In this case, major 3-week underperformance, and now we're starting to snap back that way. And again, that's another reason why we're big fans of the S&P 500 as a foundation, and then wait for the market to really be in your favor and use growth stocks to provide the outperformance. Let's move on to the VIX. VIX was down most of the day, but with the later late afternoon sell-off, it bounced a bit below the 200-day moving average and right on the 50-day moving average, above the 21-day. We want to see this get back below the 21-day. It is still, however, above that 15-ish 16 level where the market's been doing its best work. US dollar down today. In a downtrend, very clearly, this is a bounce into that downtrend line and a failure in the downtrending 21-day moving average. That's a benefit to stocks. Let's go to precious metals. Gold, Tate range today, still below the 21-day moving average. Gold stocks bouncing at the 21-day moving average. And silver giving back some of the big gains from 2 days ago, down 2.57%. Bitcoin got a nice pop today. Pulled back and closed mid-range, however, but still up 2.2% above the 21 and above the 50, still filling out this very nice flat base. On to bonds. After 2 days down in bond prices, meaning 2 days up in bond yields, we got a bounce. BND, the broad bond index, up a little less than 0.5%. TLT, the broad bond index, up 1%. And if bond prices are up, bond yields are down. Here's TYX pulling back 1.24%, and the 10-year down 1.5%. So that's our interasset correlation chart portion of our program. Let's move on to the tail of the tape. So we've got the first break below the 21-day moving average. A sustained break below there will flip us from the bull case to the bear case. And of course, weakening we added to the uptrend. Day counts. We are in a 9, arguably a 10-day consolidation, but second day down now, breaking below that consolidation. Second close below the 8-day exponential moving average, and it has rolled over. One close below the 21-day moving average on the S&P 500, and it is basically flat. Expectations flip to neutral with the action today. Uh, for the portfolio, uh, we uh, we saw the before we started to sell off, we pulled back on the S&P right to the 21-day moving average, right around it was at 52.41 there, and we started to bounce off of it. So we added some SSO. Later in the session, that turned into a failure, so we trimmed half of that SSO add. It was bought because we bounced at the 21-day. That later failed amid the afternoon selling, so we trimmed half of it. And software got hammered today. A lot of it was tied to CRM and its negative reaction to earnings yesterday. I look at this down 20%. This is a big weighting in all of the software sectors, especially IGV. You can see IGV down badly, down 5.8%. So this carried over to all of the software sector, including cybersecurity. Plus, Okta had an OKTA, so you can see cybersecurity down 2.44%. OKTA had a negative, initially opened up at earnings above 100 and then promptly sold off. Terrible candle there, down 7.8%. And this trickled over to CrowdStrike, which pierced the 21-day like a hot knife through butter and actually closed just below the 50-day moving average. So half got stopped on half of our position. You can see it bouncing nicely after hours because Zscaler, which had been a laggard, is up 17% on its earnings report. Zscaler and CrowdStrike are very close to the services they provide. So up to, and even with this nice bounce, we're still below the 200-day moving average on Zscaler, as this just got taken to the woodshed since its last earnings report. So we'll see if that remaining 3% that we have in CrowdStrike can benefit tomorrow. So overall, this reduced our exposure from 1.29 to 1.26. And the bottom line on the day, growth leaders hit hard as tech sells off. S&P 500 breaks below the 21-day moving average. Down about 0.15%. Let's take a look at the SPY very quickly. Down 0.1%, a tenth of a percent after hours as the market sorts out what's going on. We also have the Trump guilty verdict. I don't know if that is impacting the indexes or not, but we'll see what tomorrow brings. Every day brings something different in the market. No 2 days seem to be exactly alike. And we did talk in the S&P 500. We pointed out 4 dates in the past when you saw a candle like this with the negative reversal. One of them was back last July. One of them was in April. There were also 2 more during this recent move up. Here was one of them. There was another one. In 2 cases, we went sideways and resolved higher. In 2 cases, it was the beginning of a rollover lower, and that's what happened last July. That's what happened in April, and that's what's happening right now as we broke below the low of that day and the 21-day moving average. So there's always a precedent and a couple of options for how the market's going to play out. In this case, we went sideways for 2 sessions, started to get weak, and then the weakness kicked up today with the break of the 21-day moving average. So we don't get bearish or bullish. We just interpret the action as bearish or bullish and position accordingly. So let's take a look at the top 5 winners and the top 5 losers today from the 21 over 21. We'll start off with Kava. After a big shakeout on earnings yesterday, a nice up day, up 5.6% on very strong volume. Bitcoin, you already talked about that, up 2.2%. CEG regaining the 8-day exponential moving average. Gold stocks up 1%, bouncing at the 21. And CCJ, this is a uranium stock, making a higher close. Let's flip this and look to the downside. Sorry, the downside. And pausing for 1 second here. Okay, here we go. So Nutanix, this is part of what hit this is also a software name and also very much tied to AI. Terrible reaction to earnings here. It sold off 23%, breaking, and this was a leading stock. And this is why we always position size accordingly to never lose more than 1% of the portfolio when something like this happens. This is a -2 times to the downside move. That's what we base our size on. If we had Nutanix, we probably would, well, when the break of the 50, we probably would have started selling some here, but ultimately, we don't want to lose more than 1% going into earnings. We didn't own this, luckily, but it did trickle over to that, along with CRM, did trickle over to the software names, and down 23%. So that was the worst of the 21 over 21. CrowdStrike, we already showed this, is bouncing after hours back above the 50-day, but this it reports in 5 days. We've detailed over the last 3 weeks what we liked about it, how it went higher, and it just gave back 3 weeks of gains in one day. That's sometimes that just happens. Abercrombie and Fitch, after a big move up yesterday, giving back 5.8%. Transmedics, first down day in a while, breaking below the 8-day moving average, down 4%. Micron down 4%, breaking the 8, still above the 21. And NVIDIA finally showing some weakness, but note that the volume is lower than 3 of the last 4 up days, but down 3.8% today. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855 Real Wealth. That's 855-732-5932. Our flagship portfolio is named GROTECTION. It's designed to dual mandate, grow assets during uptrends, protect them during downtrends. Trend is your friend until the bend at the end. Is this the bend? It is so far, and we're watching key levels. A couple have been broken. There are other support levels below. We're mindful that last time we pulled back, we pulled all the way back to the 20-week and or the 100-day moving average. Let's show that on a weekly chart. That's this green line here. Showed support for three straight weeks before kicking off this latest 5-week rally. On a weekly chart, this looks like no big deal. On a daily chart, our short-term moving average has been penetrated, and we use that to allocate resources, and when it weakens, we take action. And if you're interested in this approach, common sense approach, every other aspect of your life, when things are going wrong, you take steps to correct it. Why should your portfolio be any different? We don't think it should be if you know what you're looking for, but Wall Street is rife with conflicts of interest, wanting you to stay in their products so they can collect their fees. That's not us, and reach out if you're interested in this approach. And with that, I'm going to wrap up the video for Thursday, May 30th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great day.